All right, so on the Money Show, we sure that we just don't talk about investing in mutual fund, but also help you meet the brains behind these funds. And in this week's Meet Your Fund Manager segment, we have on board Shridatta Bhandwaldar, Head of Equity, Canara Robeco. And with him, we'll talk about the current market setup, the sectors, his themes he's bullish on, and of course, what should be done in the small cap category. So Shridatta, good evening and welcome to the Money Show. All right, so let's begin with the market movement. How do you read the current market status? Do you see there is near-term consolidation, or you think the party that we are witnessing is about to get over? And specifically talking about mid-caps, do you think it's an overvalued space now?
As far as markets are concerned, are they at new high? Yes, of course they are at new high. But one has to step back and think as to why they are at new high and why did not they go to new highs for 18 months or 15, 16 months in between. And the predominant reason for that was effectively the core earnings growth was actually relatively subdued. You experienced a little bit of earnings downgrade for 4 quarter in between for the financial year 23. And on top of that, you had predominantly the cost of capital, which means the interest rates moving against you between, say, October of 21 to December of 22. As both these risks are receding and as you are seeing that the earnings are stabilizing, they're not accelerating yet, but as they are stabilizing, and in India, earnings are still growing, correct? So in 15 months, while the market has not gone anywhere in between, the earnings have increased by whatever 10, 12, 15%, 10 to 15%. So as the rollover is happening, that's where the new earnings are getting rolled over, and to that extent, market is actually also achieving new highs. So that's the predominant reason why market is coming to new high, because both the earnings downgrade cycle at least seems to have stabilized, and second, basically your cost of capital or interest rate environment seems to be at some point in time over next 9 to 12 months will start turning significantly favorable, and market is a discounting mechanism, so it starts discounting little early. So it's happening not only in India, it has happened in most of the countries. Of course, depending on the earnings differential or wherever growth is available, it has happened to a size in a sizable manner. That's first. Second, your question on is broader market looking little overheated or more than overheated? Is it looking like there is a little bit of upfronting of returns that has happened in near term? A possibility in some pockets, but not across the board. Yes, there are pockets where there is a little bit of upfronting of financial year 24 clearly has largely happened. So you'll need rollover of financial year 25, probably 6-8 months down the line for that part of the market to do well. But generically at market level, there are enough pockets in market where even in broad market you're finding enough opportunities. So that's how we would look at it. That's the contextual view. When you take a little longer view, and that's what one investor who's little, whether it is retail investor or institutional investor who's going to be keeping money for a year, 2 year, 3 year, 5 year, as you start actually extending the time horizon, uh, and if you actually look at the domestic context today, clearly the domestic context after a very very long period between 15 to 20, we struggled with the challenge balance sheets both on corporate side and bank side. While government was doing its bit in terms of reforms, in terms of whatever it could do on the infrastructure side, these two pockets were suffering. We have changed that cycle. You are clearly in a cycle where the corporate balance sheets are extremely clean. Your bank balance sheets are extremely clean. What it means is that you are going to have a reflation of these balance sheets over next 2, 3, 5 years. And as that reflation happens, typically business cycles play out. I'm not saying there are not no external risk or there cannot be external risks that play out intermittently, but at least the enabling factor which are needed for any earning cycle, credit growth cycle, business cycle to play out, those seems to be in place, and that's what makes me far more constructive, irrespective of what has happened in terms of upfronting of a little bit of return over last 3 months. So that's how we are looking at the contextual and more a little more structural part of the perspective on market.
Hmm. Right, got that, Shridatta. So now the other question is the immediate triggers for the market. The next immediate triggers are obviously the Q1 results. So I want to know how excited are you, and specifically, what sectors do you think and what themes do you think have, are overvalued or maybe undervalued, which might be there on your radar also.
Always excited about the quarterly results because it's one kind of snapshot where you get incremental data points. Although sometimes it also creates incremental noise, but you get incremental data points to whether they actually support your thesis or they actually break your thesis. At least you get incremental data points. So you're excited about them. As far as this quarter is concerned, first you have to think what has happened in fourth quarter. So for fourth quarter, uh, thankfully was interesting in a sense that after previous 4 quarters before that, where you were struggling in terms of earnings downgrade, last quarter was the first quarter after 4 quarters where you did not experience any earnings downgrade. At the margin, you had the upgrade downgrade ratio, which is what we call as, which means if I take a BSE 500 and or BSE 200 or BSE top 300 stocks and look at it, how many names outperform the consensus numbers expectations and how many actually underperform, that ratio has started improving. And my hunch is that will continue even in this quarter. And there are not much of a basically debate in terms of which pockets are relatively more resilient in earnings. The financials part of the market continues to be relatively more resilient. NBFCs have started actually participating as the interest rate environment is expected to start turning. Um the auto part of consumer discretionary, uh, hotels, hospitals, telecom, domestic pharma. I think these are the cement incrementally the numbers earnings upgrade cycle uh, seems to be playing out. So these are the spaces where earnings are expected to be either some of them will get upgraded, some or as a basket they will be more resilient. And then you have the other side, which is relatively more externally focused, which is your IT, commodity, energy, and some of the other exporting sectors, including part of chemicals, where the numbers are expected to be a little more subdued. But it is just, of course, contextual. So uh, that's where the quarterly expectations are as things stand today.
Right, Shraddha, let's talk about the FII flows now. So, obviously, we all know that India is a premium market, and the way we've seen the flows coming. So, despite India being a premium market, there has been money pumping in even at record levels. So, first question: is it the lack of opportunities that the FIIs are facing, and India being the only market for them, makes a very lucrative place to put all the money? And also, do you think this trend has almost peaked out, and we'll also witness a reversal in this trend soon? What do you say?
It's combination of all the things. First of all, the premiums. Yes, India has always traded at a significant premium to other emerging markets. Of course, in near term, that premium has further gone up because you have seen the kind of 10, 12%, 13% move in market over last whatever 3, 4 months, 3 months. But that premium is not devoid of reasons. The premium is predominantly because of the kind of diversified private corporate listed entities that are available in India in a sizable manner, which are very, very capital efficient as a basket as compared to most of the other emerging markets where predominantly they are very, very concentrated markets, generally towards commodities. And that is the reason you trade at a premium. China has its own issues. So even while the premium is going up, that premium going up itself is a function of both the things. You yourself doing well and somebody else actually not doing well, or they getting derated at the margin. That has also contributed over a period of time for that premium to actually sustain at a higher level or go up further. So that's as far as the premium part is concerned, premium valuation is concerned. I think they are here to stay as long as we continue to have superior earnings profile as a country, superior nominal GDP growth rate, and superior earnings growth profile comes with relatively higher ROCs or ROEs as a country. And when I'm saying country, in that 150, 200 stocks where predominantly FIs are positioned. As long as that continues, I think the premium is more or less likely to continue. And we're still young economy where probably demographics is extremely good. So we will have this runway for a long period. So that premium might not come under question very, very easily. That's my case. Coming to the second part, whether the FIs will keep pumping in money in near term or not, that's a difficult question to actually handle. How we are looking at it is what they did over last basically 24 months. That gives you a little bit of clue as to what is more likely to happen over next 12 to 24 months, as those fundamental factors in terms of effectively the earnings growth deceleration stops, and at the margin negative, neutral to positive earnings growth plays out over next 2 years, which is on a differential basis will be better than most part of the developed world, at least because those are the guys who are investing predominantly in your country. They are going into either recession or moderation of growth, at least. So your differential of growth profile, which was, if you actually look back, uh, 12 months back, 15 months back, or say uh, 24 months back, that growth profile had actually shrunk because of the kind of excess fiscal support that most of those geographies got. As that growth profile actually again turns in your favor, naturally capital should flow towards you. Also, the other enabling factor clearly is your interest rate environment. Declining interest rate environment is generally positive for growth asset classes. So both those factors are likely to, from a next uh, basically 18 to 24 months perspective, are more likely to be positive than negative, like where they were in previous 15 to 18 months. They have sold almost 25 $30 billion worth of Indian equities during that phase. They have just bought back, I think, 10 or $11 billion or $12 billion as of now over last 3 months. My hunch is the rest of the money over next 24 months, at least, if not earlier, in a homogeneous, heterogeneous manner. It will not be very, very homogeneous the way it has been for last 3 months, but that should come back given that you have differential in terms of growth profile.
All right, that was an elaborate answer. But then let's move on and let's talk about the small caps. Now, for that, do you think any trend reversal expected? We are already overvalued. What is your analysis? And historically, how have they performed as compared to large cap? And what's the way ahead now? Is it the peak out that we might be seeing in this category?
Sure. Generally, we're not believers of holding a lot of cash. Anywhere between 3 to 5% cash is what we maximum hold. So that continues to be there. So that's on cash. As far as how we are looking at this category, I think this is a fairly broad category. There are enough and more opportunities which are present. Again, I mean, circling back to the previous question that you asked, is there a little bit of upfronting or exuberance in terms of how investors are looking at this category? Yes, probably, because of what has happened over last 2 3 years in terms of the returns. I think the category itself has upwards of 30% CAGR. Naturally, a lot of retail investor, a lot of people tend to focus on that number rather than focusing on 3 5 10 year rolling returns. And as that focus has increased, of course there is little more excitement, but at the same time, it is important to understand that, as I said earlier also, that if you are going to get into a business cycle, you're going to get into a credit growth cycle, and the intensity might be different depending on how a lot of other factors play out, but at least directionally, you are in a business cycle, given that reflation of balance sheets is likely to happen over next 24 to 36 months to 48 months. As that happens, there will be a lot of businesses where the opportunities might get created in broader economy. Uh, so opportunities are present there. That is one. Second is also basically you have a lot of newer sectors, value chains, the supply chain rigid players, manufacturing side businesses, which are emerging in that space, electronic gadget space. As those businesses emerge, probably opportunities uh, are there. Near term, yes, there is a little bit of exuberance in that category, clearly.
All right, so now what investors are supposed to do when it comes to rebalancing their portfolio? Do you think that within equity only, if at all they want to rebalance, it's time to book some profit in mid cap and small cap space, if at all they are witnessing huge amount of money there?
Generally, we're not believers of holding a lot of cash. Anywhere between 3 to 5% cash is what we maximum hold. So that continues to be there. So that's on cash. As far as how we are looking at this category, I think this is a fairly broad category. There are enough and more opportunities which are present. Again, I mean, circling back to the previous question that you asked, is there a little bit of upfronting or exuberance in terms of how investors are looking at this category? Yes, probably, because of what has happened over last 2 3 years in terms of the returns. I think the category itself has upwards of 30% CAGR. Naturally, a lot of retail investor, a lot of people tend to focus on that number rather than focusing on 3 5 10 year rolling returns. And as that focus has increased, of course there is a little more excitement, but at the same time it is important to understand that, as I said earlier also, that if you are going to get into a business cycle, you're going to get into a credit growth cycle, and
All right, Shridatta, that will be all for today. Thank you so much for being on the show and helping our viewers as to how can they strategize their investment portfolio moving on.